Lesson 9. How to buy at just the right moment. When investing a stock, it is important to look at a chart to see how it is performing technically. In this lesson, Bill O'Neill explains the basics of chart reading and introduces you to one key pattern, the cup with handle. As long as the fundamentals are solid, does it really matter when you buy a stock?
We've all heard the saying, timing is everything. This is just as true in the stock market as it is in life. Knowing the optimal time to buy or sell a stock is a valuable skill anyone can and should learn. In the next 3 lessons, I'm going to show you how to read a stock's daily or weekly chart, which will give you a visual picture of how a stock's price and trading volume change over a period of time can lend clues to its future performance. Charts are essential because they communicate critical information about how a stock is acting in the marketplace, information you would miss by concentrating on fundamentals alone. Charts are graphic depictions of historical price and trading volume behavior. They allow you to identify current behavior in relation to a stock's recent history. On a chart's price line, each vertical bar represents a day's or week's price action in terms of 3 variables. The top of the bar represents the highest price the stock traded for that day, intraday high price. The bottom of the bar marks the low price of the day, intraday low price. The horizontal intersecting slash shows where the stock closed for that period. At the bottom of the chart is a graphic depiction of the volume that traded for that same period, daily or weekly.
But how do you make sense of all those bars and slashes?
We've discussed the importance of volume. Now let's make the connection between volume and price. A constructive sign, easily identified on a chart, is large increased volume from the day or week before with the price moving up. This normally indicates accumulation or professional buying of a stock. A sign of potential trouble or distribution, professional selling, is increasing volume as a stock drops in price. On the flip side, if the price is trending down but the volume is also trending down significantly, there may be little cause for worry in that the decreased volume shows the stock is not being heavily sold. However, like most things, it's not quite this simple. In the next lesson, I will go over specific exceptions to these generalities. I use both technical and fundamental indicators because there may be signals that appear in a chart, on the technical side, that may precede publicly or professionally known changes in the fundamentals. This is especially true when leading stocks hit their price tops. Some stocks can top while current earnings and estimated earnings look great. During our 45-year study of the greatest stock market winners, in addition to looking at fundamental measurements, we focused on the technical indicators of price and volume movements and patterns by studying charts on all the outstanding stocks. What we found in common was that price consolidation areas or specific types of base patterns occurred in the stock's price movement. These bases were formed just before the stocks broke out into new high ground in price and then went on to make their biggest gains. These base patterns were usually caused by corrections in the general market indices.
So what does the chart of a future big leader look like just before it's ready to break out to a new high in price and advance 100% to 200% or more?
There are 3 primary patterns. One of the most common we named a cup with handle. It was named this because the general shape resembles the outline of a coffee cup. See the graph on the next page. Points A to B is the left-hand declining part of the cup. B is the bottom rounding out process of the cup, with the price going back and forth for a few weeks, and from C to C, the stock rallies back up in price to a point usually just below its old high. Then C to D to E forms the handle. The entire area from point A to point E is called a cup with handle. Also, as part of our study of these winners, I identified an optimal buy point or pivot point for a stock. How? This point, usually at the end of a sound basing area when the stock price breaks out into new high ground, is the point of least resistance. This means that at this point the stock has its greatest chance of moving even higher based on its current and historical price and volume activity. In the cup with handle pattern shown, the correct time to buy the stock would be as soon as it trades 1/8 of a point above the peak price in the handle, at points C, D, and E. While we call this a new high, it is actually a new high breaking out of the handle trading range, which is usually a little below the actual old high price at point A. This gives you a slight jump or edge on the stock.
Why don't you just buy at the bottom of the cup?
People feel uncomfortable waiting for a specific buy point, especially because most of the time it is at a higher price than other prices in the basing area. They ask, why not buy earlier at a cheaper price in order to get a better deal? Why wait until it is up a few points higher before I buy? The objective is not to buy at the cheapest price when the probability of the stock having a huge move may be only so-so. The objective is to buy at exactly the right time, the time when the chances are greatest that the stock will succeed and move up significantly. I found through our detailed historical studies that a stock purchased at this correct pivot point, if all the other fundamental and technical factors of stock selection are in place, will simply not go down 8%, your protective sell rule, and has the greatest chance of moving substantially higher. So ironically, if done correctly, this is your point of least risk. On the day the stock breaks out, its trading volume should increase at least 50% above its average daily trading volume. It's important to have big professional demand for your stock at this key buy point. Only Investors Business Daily's unique stock tables show you each stock's volume percent change daily. On our chart, the dashed line from points X to A is called the prior uptrend. Strong, healthy stocks show at least 30% price increases in their prior uptrend. A proper cup with handle must take at least 7 or 8 weeks to form, from point A to point E. Otherwise, it may be unsound and fail after its breakout. Some bases may actually be 3, 6, or as many as 15 months in duration. Most decline 20% to 30% from their absolute peak to the low of the cup from A to B. Handles can be a short 1 or 2 weeks or a number of weeks long and need to drift downward along their price lows or have a shakeout break below a prior week's price low in the handle. This serves the purpose of getting a needed pullback or price correction out of the way. Proper handles rarely pull back in price more than 10% or 15%. They will usually show either a marked dry up in volume near their lows, which means there is no more selling coming into the stock, or they will have several tight areas where the price varies only a tiny amount and for several weeks may close virtually unchanged in price. This is a constructive signal.
Seems clear in theory, but do actual stocks really form such patterns?
Here's a classic example of a cup with handle pattern. Microsoft in January 1991, 1 week before it broke to new high prices and went on to more than double in price. See the chart on page 46. Its EPS rating was 99, and its relative price strength rating was 96 at the time. Microsoft formed a 25-week base. It declined 6 weeks on the downside from point A, moved back and forth along the low of the cup at point B, rallied up in November, point C, and then formed a very tight handle, points DE, in the last 5 or 6 weeks. Note that the handle is in the upper half of the overall pattern, points C, D, and E. I've placed arrows on 6 different weeks along the low and on the uptrend in the base where volume, shown on the bottom of the chart, increases from the week before with the price increasing. The 2 largest week volumes were on big up weeks in price, with the price closing at the peak for the week. Note also the extreme volume dry up in December to the lowest weekly volume level on the chart, and the small tight price movement in late December and early January. Your precise buy point is the peak in the handle area. Again, this is not the lowest price, but the price at which your probability of being right is highest. That's why you wait for the stock to hit this price before you buy. Sometimes they never get to this point. Until you get used to it, it will seem scary, strange, and hard to believe that the correct way to buy is when a stock is near the highest point it has ever been. In fact, 98% of individual investors never buy this way, and that's why few will ever own or fully capitalize on the really big new winners that occur year after year in the U.S. stock market. Just remember, buying at new highs is buying into emerging strength.
Summary. 1. In studying the greatest stock market winners over the past 45 years, I found specific types of base patterns. These bases were formed just before the stocks broke out into new high ground in price, and then went on to make their biggest gains. 2. The most common pattern is a cup with handle, named so because it resembles a coffee cup when viewed from the side. 3. The optimal buy point of any stock is its pivot point, the point at the end of a basing area when the stock price is breaking out into new high ground. 4. On the day a stock breaks out, volume should increase 50% above its average daily trading volume. 5. Remember, you want to buy a stock when it's breaking into new high ground. 98% of individual investors never buy this way, and that's why few will ever own the big stock winners. 6. Increased volume from the prior day, week, with the price moving up is generally a positive sign. 7. Increased volume from the prior day, week, with the price moving down is generally a negative sign. 8. A decrease in price on decreased volume indicates no significant selling.